All right, I am here with Jeremy Pope, the Pope of Loans from PRMG. Hey, Jeremy.
Hello, how are you today?
I'm good. How are you?
I'm great. I'm great. Thank you.
I have a burning question.
Okay, what's that?
What, explain to me what happens after like the loan closes. Where does it go?
So,
Because it doesn't always stay like with who you signed up with. It's
right,
confusing.
right, right, right. So there's a lot of options banks have in terms of what they want to do with loans, right?
Okay.
So some banks don't keep any loans they do. Some banks keep 20, 30, 40, 50% of what they originate. They transfer the rest off to another investor, which is usually just another bank.
Okay.
Yeah, so it's interesting. They can go to the secondary market, and then Wall Street's involved. Then they turn them into mortgage-backed securities. So you can buy bonds that are tied to the mortgages.
Wow.
It's a basket of them, and yeah, lots of different things you can do.
But this is like, depending on what the bank is going to do with it, that's part of the requirement for the loan, right? Because whatever, if they're going to buy it, then they want certain things in it, right?
In a way, I know what you're asking. I know what you're asking. In a way, so what it really is that if they're going to hold on to the loan forever, the bank can just like do whatever they want.
Okay.
If they like the risk, then it's their money. So they hold the loan on their books. They collect the interest, they collect the checks, they disperse escrows, they handle it all.
Mm-hmm.
So that is generally portfolio lending. I don't think it's as common as it used to be.
Well, yeah,
But
because that ties up the bank's money and the bank wants to lend.
yeah, there's like depository institutions, banks that take on checking and savings and have deposits. They're required to lend out some of the money that they're bringing in, but they can't lend out too much because then people can't get their money if they want it.
Right.
So there's certain ratios, certain rules for them and rules for non-depository, which is, we're a mortgage company. We don't do checking and savings, so we're non-depository. But yeah, if it's portfolio, they make the rules. They do what they want. And then if they're going to try to sell it on the secondary market, that's when you hear like Fannie Mae and Freddie Mac and FHA and VA and USDA. Then you have to meet their rules. Otherwise, you can't do, can't sell it. Like
They won't buy it.
Exactly.
Yeah. So like in the real estate world, they're like the iBuyer, the investor buyer that's like, I'll buy this house, but it needs to meet this criteria or else I don't want to buy it.
I think what it really provides is transparency to the investor, because they know that they are only buying loans or only buying investments that meet the qualifications of Fannie, Freddie, FHA, USDA, VA, whatever. So they know what they're getting, as opposed to, I think what happened, if you've ever seen the movie Big Short, that's a phenomenal movie in terms of like making it so that people understand what was really going on. These investors were kind of tricked into, they thought they had something, but they didn't have what they thought they had.
Right.
They thought, well, we got all grade A paper from Fannie Mae. No, you've got some of that, but then they're sliding in a bunch of junk and calling it all, hey, this is all good stuff here. No, it's not.
It's not. It wasn't.
It provides transparency for the person that's
but how does it does matter what the bank is going to do. It does affect the borrower.
It does. True.
So it would affect them in the amount that they have to put down. Like maybe if the bank is going to hold it, they might want more money down, right?
Correct.
Or like if you're going to sell it to Fannie Mae or Freddie Mac or whatever, then it's like they want certain debt to income ratios or something like that.
Right. Yes, it does affect the borrower. Hopefully banks are just being transparent about what could possibly happen with their loan after it closes. Sometimes it's a little bit of unknown, you know, you could keep it, we could transfer it, we could.
But most of the time it gets transferred to, like, you're paying a different company.
Sure. Most of the time, I feel like it does, correct. But there is a silver lining to that. Whereas, like our company, for example, where, you know, we could go direct to Fannie Mae and Freddie Mac with the loan, or we could go to an investor, which is another bank.
Okay.
Now, Fannie Mae and Freddie Mac deal with billions of dollars worth of mortgages every month. So do they really care about your individual mortgage? No, they don't at all. So they're not going to give premiums in terms of rates for that, right? To whereas a smaller, when I say smaller, these are still mega huge companies, like Fifth Third, right? Fifth Third is not small, but they're a lot smaller than what Fannie Mae and Freddie Mac deal with, right? So if the investor on the back end is Fifth Third, they should be more aggressive with their rates than in terms of like just selling direct to, you know, the mega whale out there, which is that Fannie Mae.
Gotcha. Huh. That's interesting. It's crazy, like, how big the whole process is.
It is.
It's mind blowing.
Interesting to see what kind of happens there. The people that are dealing with that, I know for our company, the guy's name is Gary Malice. He does a monthly call. There are many times when he's talking that everybody's eyes are glazed over. Like, what are you even talking about? He's talking about hedging the bet and arbitrage and all this stuff. The people that are in the secondary marketing world are, for the most part, super intelligent people. And they
good at math.
Explain it so you and I can even understand it.
Exactly.
Yeah, it gets very, very complicated.
I'm sure it does.
The best way I could say it.
Yeah, no, I get it. So is there something that the borrower, when they're considering who to use for their loan, is there something that they should be asking or should be thinking or considering? Based in like where the bank is going to sell it or what they're going to do with the loan? Does it even matter?
I feel like it's a question that pops up less and less than it used to. Okay. The whole idea of I want to be able to walk into this place and hand them my check and I know it's paid, that still goes on. There are still people who want that. But I think as technology moves forward, I think it's a little bit of an older generation wanting that. You know, it's less and less. I think at the end of the day, and this is just my opinion, but the conversations I have with people, we seem to be on the same page. I think they would rather have a better deal on their mortgage than knowing that they can walk into a brick and mortar place and make a payment. Right. You know, but there's always going to be people that are like, you know what, I'll take a higher rate so I can walk into that place and talk to Susie every month and hand her my check.
No, that makes sense. I get it. Cool. Well, remind us what states that you lend in.
Ohio, Indiana, Kentucky.
Super. And what is the best way to get a hold of you if you're an agent wanting that has a client that needs a loan, or if you're a buyer that is looking for a lender?
I cell phone still 513-432-6971. We've got a team of people here that want to help, and welcome to check out any reviews, and of course do your homework. That's important for sure. Yes. And you need a good agent, which you've always delivered, Jennifer, always. So
awesome. Well, I appreciate you being on. Thank you, Jeremy.
You're welcome. Thank you.
See ya.